Volatile power markets are reshaping procurement economics. There was a time when energy price spikes were treated as temporary disruption. Finance teams absorbed the fluctuation, suppliers passed through a surcharge, and contracts normalized the following year. That cycle is no longer holding. Energy volatility is not just a macroeconomic condition. It is becoming a structural variable inside supplier pricing models. And procurement strategies built on historical averages are starting to show strain. The baseline has shifted. Over the past several years, natural gas, electricity, and fuel markets have experienced repeated swings driven by geopolitical instability, weather-driven demand spikes, infrastructure bottlenecks, rapid electrification and data center load growth, tight reserve margins in key power markets. Even when spot prices retreat, forward curves remain elevated relative to pre-2020 norms in many regions. Suppliers are noticing. Energy-intensive industries are increasingly embedding energy risk buffers directly into pricing structures rather than treating volatility as an exception. The implication is subtle but material. Price stability assumptions are weakening. Contracts are carrying more risk allocation language. Procurement teams are seeing changes in contract language that were once rare. Expanded energy cost pass-through provisions, fuel and power index linkage clauses, shorter fixed-price windows, escalators tied to wholesale market benchmarks, force majeure definitions that include grid instability. Suppliers are less willing to absorb sustained energy price exposure without explicit cost-sharing mechanisms. In some cases, long-term fixed pricing is still available, but only at a premium that reflects forward volatility expectations. What was once margin risk for the supplier is increasingly shared or transferred to the buyer. Volatility is now embedded in capital decisions. Energy pricing does not operate in isolation. When power costs spike or remain elevated, industrial producers delay expansion, facilities defer electrification upgrades, equipment procurement cycles stretch, sourcing shifts geographically. Regions with historically stable energy pricing are becoming more attractive, not just for sustainability reasons, but for margin predictability. In parallel, suppliers located in markets with constrained grid capacity or exposure to volatile fuel inputs are adjusting pricing models preemptively. Energy is no longer just an input cost, it is a strategic differentiator. Data centers and electrification are compounding the pressure. Rapid growth in electricity demand is tightening reserve margins in certain markets. Where generation and transmission infrastructure lag load growth, wholesale price volatility tends to increase. Suppliers operating in those regions face higher variability in operating costs, even if average prices appear manageable over time. For procurement leaders, the question is no longer simply, what is the current energy price? It is, how exposed is this supplier to energy price swings over the next 5 years? Budget cycles lag energy markets. Most organizations still build annual budgets with moderate escalators for input costs. Energy volatility, however, can move quarterly, sometimes monthly. When supplier pricing resets mid-cycle, it competes directly with capital project funding, workforce investment, sustainability initiatives, inventory strategy. Repeated volatility reshapes not just cost lines, but planning discipline. Finance teams are increasingly stressing supplier contracts against energy price scenarios, rather than assuming reversion to mean. What procurement and finance teams should be reframing? If volatility is structural rather than cyclical, the strategic posture changes. Key questions now include, are we overly concentrated in suppliers exposed to the same power market risks? How much of our cost structure is implicitly indexed to natural gas or wholesale electricity? Are we modeling supplier energy exposure as part of our risk assessment? Do long-term agreements include mechanisms that protect both sides from extreme swings? Energy is not just a sustainability metric or operational cost. It is becoming a persistent source of pricing variability across supply chains. When volatility becomes structural, the negotiation dynamic changes. Suppliers are pricing it in. The question is whether buyers are pricing it in fast enough. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.